Thanks everybody who's joined today from all time zones. So good morning, good afternoon, good night, if you're on the India spectrum. But thank you for joining us. My name is Lindsay Caldwell-Umala, for those who don't know me, and I'm the Director of Country Transitions for the Clean Cooking Alliance. And we're super excited to have you here today. We've been working closely with Greencroft Economics on the development of this tool and the associated report on unit economics, but just to say that we feel like this is really just a launching off point for what we hope will be a much broader dialogue around unit economics for the clean cooking space. I am facilitating for today, but I'm going to hand it over in terms of introduction to my colleague Faisal Hussein. So Faisal, over to you to get us started, and then we'll pass over to Ed to begin the technical training. And then just kind of a quick reminder for everybody who's maybe less familiar with Zoom webinar. Unfortunately, or fortunately, it does not let you all speak, only those with a panelist access, which means that any questions you might have, please enter them into the Q&A chat box, and we will be reserving at least the last 20 to 30 minutes of the session explicitly to answer questions. So that will be a good portion of our approach today. And as I say, Faisal, over to you.
Thank you very much, Lindsay. And Lindsay's been sort of leading us through this whole process, and it's taken 2 years. So just wanted to acknowledge, it's been a really hard journey, and this is like the and thanks for getting us to this stage. I see some people I know those of you who are attending, but just to frame where this has come from, you will all be aware of the Catalytic Finance Accelerator. We began we launched it about 1.5 years ago, and in a sense, this particular project on unit economics was one of the first projects we took on as part of the accelerator. You will know that the central purpose of the accelerator is to mobilize $100 million by 2026 of investments, and about $500 million by 2030. And our core approach is really to de-risk investments through a combination of both financial interventions as well as non-financial. And we have 4 major sort of ways we're trying to do this, and I just want to frame it in terms of where this sort of sits. Apart from us working on areas of enabling policy to create an enabling environment, developing standards and so on, that's sort of one bucket. Second is really priming companies and project developers for investment. And I think many of you who are here, that's your core kind of function. That's what you do. I'm really happy to be working with you around this. The third is really stimulating adjacent sectors in banking and off-grid electric and nature-based solutions to how we bring different investments from the adjacent sectors into clean cooking. And the fourth is how do we reduce the time, cost, and effort for investors in making investments into the clean cooking sector. And so about 1.5 years ago, when we did start the Catalytic Finance Accelerator, we recognized that there was a real problem of information asymmetries that's blocking investors who are already investing in clean cooking, but that are sort of slowing down their movement into either new markets or new business models or new sort of sectors. And everyone's going through the same process of just analyzing data before they make that decision. So we thought there was a sort of a time and effort gap there, or heavy lift. And then even worse for investors who are thinking of coming in, and for them it's even worse. They have very little information about the market, about a country, and just about the economics. And for many of you who've either worked in investment, you're currently doing it now, a central part of making an investment decision from a no-go to a go is to really understand what the unit economics is, how a particular investment might fare in relation to a benchmark that might be available in investment for the sector or a business model. So our starting off point was really to think about, well, if none of these things exist across the industry in a standardized way, how do we how do we try and solve the problem or one of the problems of getting more investment in the sectors. That was the sort of origin of it. And so we were very grateful to be working with both Greencroft and Tangana Advisory to help us think about how do we. So we did two things. One is a commission to research. One is to just generate enough data that can be comparable across different models, different countries, so that we can get towards a standardized set of data, which could then be a jumping off point to really test our hypothesis of whether these types of information help drive investment, right? So that was sort of one kind of reason for why we thought it would be important. And the second was the development of a tool that can then provide an on-ramp to generating data at scale, because right now almost all the data collection just happens to be individually different organizations collecting it and then keeping it proprietary, right? But we kind of realized quite quickly that the companies weren't really sharing a lot of their data and weren't very keen to share that. So we quickly pivoted, and I think Ed will take us through that experience, and I think that's really instructive. And what started off as a way of thinking about creating a sort of sector-wide standardized methodology and standardized data sets, we realized that actually we need to pivot in a way that we have to create better use cases of this tool and the need for the standardized data, not only among enterprises that we need the data from, but also from aggregators like many of you who are already collecting and doing a lot of the work, but it's just that everyone has a proprietary methodology for doing it. So we think what might happen over time is, with your help and cooperation, that we can try to go from a journey where we can work on a sort of a standardized methodology to test it out only with enterprises. There's without any expectation of the enterprises sharing the data, but it's of value to the enterprises themselves. Hopefully that can then sort of move this along to the company sharing the data with the promoters, such as yourselves, and then you have that data. Then over time, when there's sufficient volume, then we can hopefully anonymize much of that data and then start getting to where we think we're hoping to get to, which is a much more sort of consolidated version of the sector information itself. So, the holy grail is to try and get that, which hopefully we can do. But, we recognize that actually we might have to go through a little bit of a journey to build confidence among companies as we go along, and confidence among yourselves. And I suppose the final thing I would say is that the question for us is, how do we go from having a tool or doing some of our data-related work, or you doing the data-related work, that transition us from doing this work to generate private benefit for the companies to creating a public good for the sector itself, right? So that's a challenge that we have to kind of face. And I think if we can sort of all work together, because we've all got access by collectively, we have so many companies we are working with. If we could do that, that would be a tremendous sort of benefit for the sector moving forward, while also benefiting the companies and aggregators as well. So, so this is really it's taken quite a long time, but we've, sometimes great things require a bit of time to get together. So, so with that, just really welcome everybody. Thank you very much for coming, and just thanking Ed and Lindsay for leading us through this process and starting a new process moving forward. So, with that, Lindsay, just hand over to you. Thank you.
Thanks so much, Faisal. I am not going to be one of those MSCs that does a little bit of a routine. So Ed, I'll just hand it over to you to get us launched on the actual training.
Fantastic. Thank you, Lindsay, and thanks, Faisal, for the introduction and context. I have the pleasure of talking you through the development of this toolkit and at least some examples of what it does today. But just echoing Faisal's comment, should also acknowledge it's been a team effort with Stephen Nash and Femi from Kungana Advisor, and also Iwana, who's on the call as well. So I get to sit in the hot seat, but there's lots of people who've been working on this. I'm going to share my screen and I will be flipping a little bit backwards and forwards across between some slides and hopefully a practical demonstration of how the toolkit itself works. So please bear with me as I jump back and forth. And I think what we'll do is we'll try and present for about, I think it will take about 30 minutes or so, just to give an overview of what is in the toolkit, acknowledging some of the limitations that Faisal has spoken to you very well, and then a few worked examples of the types of outputs and results that the toolkit can produce and how to do that. And then I will make sure I leave a little bit of time to come back to acknowledging some of the limitations of the toolkit and the data that it's built on, and also some of the things that could probably it could be extended to, or some things it doesn't yet do, which would probably be fairly logical extensions of the type of analysis we're going to present. So without further ado, the purpose of the toolkit, as far as I said, in a way, it's a horse for many courses, to use a sporting analogy. It's been designed in a way to try and help answer sort of market level questions, potentially for financiers, potentially for ventures themselves, or potentially for program designers who are looking at what a particular country market might look like. So what it is it's a framework to structure and build evidence around. It provides some external benchmarks of unit cost and indeed some unit revenues and how those are likely to evolve over time. It is absolutely a model, so it's a simplification. It's a simplified toolkit. It isn't a prediction. It isn't intended to or trying to guess what reality is going to look like in the future, or claim to model the nuances of a particular company venture. It certainly isn't at that level of detail, but it does have a high degree of flexibility to let you make your own choices, and to some extent to put in your own data as well, and the tool can update based on your data inputs and your selections, and I'll show you how some of that works. I guess on the last point, it is anonymized and confidential, and I guess that's an easier statement to make than it might have been when we set out to build this toolkit, in that the toolkit we're going to present to you today does not have an engine room behind it of hundreds of data points from companies which have been grouped together, aggregated and made confidential. We were hoping to try to do that, and I think that's something that as Faisal said, it would be good for the industry to be able to do in future. We didn't have enough response rates to the surveys we sent out and enough data points to be able to do that. And part of the complication for the clean cooking sector is there's obviously a very sophisticated range of technologies on offer, of business models and different company and country contexts, that actually to be able to have enough data to start providing anonymized benchmarks, you need quite a lot of data. So the tool we're going to present to you today is based on our understanding of some of the data we received on existing reports and on third-party data sources. It doesn't have a large database of anonymized company data sitting behind it, and I think that's worth just making sure you know that it's what it is and isn't based on. Okay, so the toolkit itself it's very user focused. That's not necessarily to say it's easy to use. There's a lot going on and a lot you can choose, but it really is a sort of interactive. It's intended to be an interactive toolkit where you can make selections, and it will automatically update a few standardized outputs to help understand the possible evolution of unit costs and of unit revenues. Now, I guess we've built that and designed that, obviously in iteration with colleagues at the Clean Cooking Alliance. But I think one of the questions that we might open up to at the end of this presentation is to understand what other types of outputs or graphs or indicators might be of use or might be of interest that you don't see when we talk through today. And then we can think about sort of the extent to which this toolkit may or may not be able to produce those as well. It includes quite a lot of optionality around technology and cost structures, but also around some revenue generation options, including a module which allows you to look at what monetization of other outcomes might look like and might do to the timing of unit revenues and unit costs. I think my overall message on this slide would be I think the main use case of this toolkit really is to look at comparisons of different selections. So to compare one country to another, or to compare one technology to another, or to compare the same technology at different points in time. So it's an illustration of what a company journey might look like, rather than a benchmark or a prediction, if you like. And we'll talk through some of those examples, but I think there is some interesting stuff in here on what deepening market penetration looks like, and the extent to which you see either economies of scale or diseconomies of scale. So unit costs going initially down, but then potentially up later on in the company journey at different rates of market penetration. I hope that makes sense. So without talking you through all of the tabs in an Excel file, I hope you like looking at Excel files, because we're going to do quite a lot of that very soon. But without talking you through all of our many and various sheets in the Excel file, in a nutshell, what we have got in the model is a control panel. In fact, two. There's one main control panel. There's also a parameterization tab where a more detailed series of selections can be made. There's then a couple of sort of engine room sheets which look at have built-in cost and revenue drivers, and then sort of project how those cost and revenue drivers affect unit cost and revenue over time. All of that is based on the selections made on the control tab. And I guess in a sort of unidirectional flow of calculations, that then spits out a dashboard of visuals. All that to say, for most users, if not all users, I think you're probably going to look at, if you do use this toolkit, the control panel and the dashboard, which sit next to each other. And there's a bunch of stuff that happens in the middle, which hopefully you never have to look at. But there is some explanation written throughout the model so that you do know what those tabs are doing. Cool. Before I get into the Excel file itself, we have 2 or 3 slides just to give examples of what data is in the toolkit and why, given the caveat I mentioned earlier of the lack of sort of primary venture level data. A couple of things we have built in on the cost driver side are population density data points and rural quality of rural road access. The reason we've done that is we think or know that they are important drivers of downstream costs, so getting from central warehouse to distribution to the last mile. And just to give a couple of illustrative examples, Rwanda is an extremely rural population. However, it's also relatively densely populated. Whereas if you look at a country like Ethiopia, you've got larger urban centres, but you've also got a far greater share of the population in very low population density areas. And that's going to matter when you start scaling up, that what happens to your costs in a country like Rwanda compared to a country like Ethiopia or Mozambique, where you've got lower population density. Once you start penetrating into those low population density regions, we at least think there's a risk of your costs going up quite quickly. Similarly, on the rural infrastructure side, what this is showing is the share of population within 2 kilometers of an all-season road. And so while most Kenyans, 28% of Kenyans are living in urban cities, the remainder are classified as rural areas. However, the vast majority of those Kenyans living in rural areas are within 2 kilometers of an all-season road, so reasonably good access to road infrastructure. On the other hand, again, Ethiopia coming up as an example the second time, and Malawi have quite a large share of their populations that are living in rural areas, and indeed are living quite a long way away from an all-season road. So if you're looking at setting up a distribution network to serve those customers, you're facing a different challenge to the one you might be facing in a country like Kenya. The other side of the model that we're not going to look much at today, actually, in terms of worked examples, but that is built in, and there are outputs produced for this as well, is looking at the revenue generating side. And so one of the things we've done on this is to embed some admittedly simplistic modeling of ability to pay. I think lots of you will have seen this sort of stuff before, looking at the attendees. This is all based on consumption expenditure distributions for each of the countries that we've included in the model. I think we've got 8 or 9 countries built into it. And what it is doing is looking at the ability for households to allocate expenditure towards energy access and how that changes from one country to another. So just to give an example of what that looks like in a country like Kenya, based purely on the database we've used, it looks like about 50% of the population could be spending close to $30 per month on energy access, whereas in a country like Tanzania, that drops to about $15 per month. And in a country like the Democratic Republic of Congo, you're looking at down around about $7, $8 per month. So clearly some quite big differences in ability to pay for energy access and clean cooking technologies, depending on the country context you're looking in. And I guess hopefully what you can start to imagine is when you put together those cost drivers that I just presented on the previous slide and how those vary by country, and then you start to match that with these revenue generating demand side country contextual factors, you start to get quite different results in terms of addressable market and the viability gap for serving all of these customers with clean cooking technologies. It's going to look quite different based on how those costs and revenue scale up in different settings. Brilliant. So I'm now going to try to give a few worked examples from the toolkit. This is a recipe for things to malfunction, but hopefully I'll be able to get the toolkit to play nicely and produce the results that I'm going to show you on the slides. We're going to go through 3 use cases just as examples. I will say the toolkit can do a lot more than what we're going to show you in these 3 examples, but we just wanted to give a sort of practical illustration of what you could do with it, albeit it's not exhaustive. So the first example we're going to give is, for example, a stove distributor who knows their technology and is already serving a core market very successfully, but is looking at scaling up their operations and or thinking about expanding into other technology types. And so what the toolkit lets you do is quite quickly compare the cost structure of different technologies and also quite quickly compare the cost breakdowns at different unit volumes. So just as an example of the types of results we can produce, we're going to start with a basic example, and we'll come back to this as our default throughout the presentation, of a tier 3 biomass improved cook stove distributor operating in Kenya, importing their product, but then serving the full value chain through to distribution retail services in country. Now, the 2 graphs on the right here show unit cost structures at 50,000 units of sales and unit costs at 3 million units. And I'm sure there are people listening and thinking those are large numbers, and you'd be right. And we're going to look at some other scales in subsequent slides. But just as an example of how that works, if I flip over to the model, and I realize this is the first time you'll see this, so let me just explain how it's structured and how it works. There's a very brief overview tab which sort of gives you a bit more detail on what the overall purpose is. There is also a cell key, so I'm not sure these are particularly pretty colors, but there are different color codes which tell you what each cell in the model is doing, and it also tells you that you're really looking at changing the sort of green and teal cells, and potentially the gold colored cells are things that you can edit. The rest is all really calculations, and you shouldn't be changing. Then, as I mentioned, we have essentially the tab you'll spend most of your time on if you use this is the control tab, and this is where you make all of your selections. So before I show the results that I just put up on slide, there's a few flags at the top of the tab that will tell you if there is an error in the model that you need to fix. And just to give an example of why that might be, some of the results are updated by running a macro with the big conveniently named run button. If you change selections, so for example, if I go from Kenya to Ethiopia, it will remind you to update the results before you flip over to the dashboard tab. And that will be done anytime you change a selection on here, to make sure that when you do look at the dashboard, you're looking at the right results. What it will also do is there are a couple of countries where we didn't have complete data. I think Madagascar is one of the examples. Yeah, and here it will give you a second error tag that tells you to go and look at a couple of red flags that are highlighted on the detail parameters tab. Now, if you leave them blank, they will effectively be filled with zeros, but it will just tell you, and if you go to the tab, it has some steps through to highlight exactly where you need to look. But just so you know, that's what this top dashboard is telling you to do, and it should direct you to where you want to make your changes. The rest of what is sort of essential selection on this tab is selecting what technology you're looking at between biomass, ethanol, LPG, electric and biogas, selecting the stove type related to that technology, and then I think a key selection is, are you looking at stove only, fuel only, or a combination of both? And the reason that matters is, skipping ahead a little bit, within the selections you want to make in terms of your user choices, there's a panel for stoves and there's a panel for fuels. Now, if you have selected stove only, then it will grey out and sort of block your fuel selections, and you don't need to make them. So when anything's greyed out, it's telling you you don't need to edit this, and that all updates automatically. To give another example of how that works, we'll talk about this as an example later, but you have the option of turning on carbon revenues, which I think you could also use for other outcomes. And again, if you've selected no, you don't then make any of the selections underneath. If you select yes, these all become active and are live choices that you need to update for the model to work correctly. I appreciate that's a little bit of a whistle-stop tour to lots of stuff that's on this control tab. I will give a few examples of some other stuff on here and you'll see how it works. But just to speak to this first example, we're looking at a stove distributor going from 50,000 to 3 million units in Kenya. So what I do is I select biomass, tier 3 stove in Kenya, stove only, and I am then going to flip down to this section here where I have selected to start at 50,000 units and to get to 3 million units, and that takes 10 years. So it takes 10 years for your hypothetical company or market to achieve that scale. If I go back up here, I'm now looking at the vertical selected for 2024. So my outputs are being produced for the year 2024, i.e. the first year of the model, which gives us the cost breakdown that you can see on the slide here. At 50,000 units, adds up to $76 per unit. Now, if I want to see the cost breakdown at the end of that process, so at 3 million, I need to go to at least 10 years later, so 2035. It reminds me that I've changed something so that I might want to rerun the model. I know that I don't need to for this selection, and I can go over to the dashboard, and I've now got the second graph that you see on the slide with a little bit of a rounding difference, but that's all it is, I promise, which gives you the same, a different cost breakdown on the basis of having reached a different sales volume. So you can see how the unit costs are expected to change, essentially based on that volume difference. If that makes sense. I think part of the reason you might want to do that is, and we'll see another slide on this later, to understand both how the total unit cost is likely to change over time, but also where it's likely to change. So you can start to identify what are the opportunities for bringing costs down and what are the risks across the different cost centers. Just to give maybe one or two more examples, we could look at, instead of that biomass distributor, an electric pressure cooker, and we could also look at the moment we're looking at cash sales only. We could also look at what happens if you were to do all of your sales using the pay-as-you-go business model. And just to show you how that works, if I go back into this model and I put us back to our start year, we want to look at electric, we want to look at EPC, still stove only, and the only other thing that I think I've said we want to change is we want to change this proportion of pay-go sales from 0% to 100. Again, there'll be a warning telling you you've changed stuff, so there are results that won't be updated. However, for this one, this first graph does update without you rerunning the model, and it gives us that breakdown that you can see on the slide here of a total of 142.2 or $0.3 of unit cost. So that's sort of the core principle of the model, is to let you select through different technology types and see what happens to unit costs. I won't do these, so it's not too torturous of watching me press buttons in Excel, but via the same process of changing the business type that you're selecting, the fuel type, and some of your sort of business model and production type options, you can produce the same sort of results for a fuel-only business model or for stoves and fuel for a range of different technologies and business models. So it's pretty flexible in producing those unit cost breakdowns and how they change over time. I'm going to put that back so I don't forget. I'm going to go back to 0%. Okay, so moving on to a second use case, and I think these are possibly the more interesting ones. This would be, for example, a distributor or investor who's established in one market but wants to understand the potential to take their business into a new geography and how that might look different to the current market that they're operating in, particularly understanding the scale of the addressable market in new countries and just how big they could potentially get, or how big they need to get to see attractive unit economics. And what the model does is it's built a series of proxy supply and demand curves that I mentioned earlier that help to tease out the answer to that question. I'm going to show you how to produce one of these graphs, and then I'm just going to talk through what the interpretation of the others would be. And I will say these are all based on user-defined input, so we're not suggesting this is we're not predicting this is how attractive different markets are. But I guess the shape of the curves probably is something that we think makes sense. So the top left graph is showing you what scaling up in a country like Rwanda would look like. Again, looking at a tier 3 biomass cook stove, but going from low sales volumes of just 5,000 a year up to 100,000 a year. And I guess the key point is you would initially be looking at small sales volumes. You're making a loss based on the assumptions that we've put in there on what your pricing is. However, that quite quickly starts to turn positive, and indeed continues to look quite attractive as you scale up and penetrate the market further. Now, this does relate to what we talked about earlier, which is Rwanda is reasonably densely populated and has reasonably good rural access. So as you start to scale up in a country like Rwanda, it goes positive, and actually it's going to remain positive for quite a long time if you can generate those types of sales volumes at the price that we've got in the model. Now, Zambia's a bit different. We're looking at a different scale, so I'm going to look at the top and the bottom graph, looking at going from 5,000 to 1 million sales, and then from 5,000 to 5 million sales. And I guess this is the net unit revenue, so it's unit costs net of unit revenue generation. What this graph is telling us is that, again, when you start out at 5,000 units, you're making a loss of about $4.40 per stove sold. And then there's a sweet spot between anywhere from up to about 500, 700,000 units, where we think you're probably getting economies of scale of production and distribution costs. So your costs are starting to go down, and your revenues are staying high at those sorts of sales volumes. Before around the 600, 700,000 unit mark, it starts to flip and go negative. And the reason for that is mostly on the cost side, where you are starting to creep into increasingly rural customer base that is increasingly sparsely populated and increasingly far away from all-season roads. Which, if you look at the bottom graph, obviously the scale is now different. The years are the same, but you're going from 5,000 to 5 million. So you're already up in around 1 million unit sales volume in 2026. And it sort of identifies, I think, one of the key risks for a market like Zambia, that there is a sweet spot where the unit economics is going to look positive, but it's going to look potentially quite negative quite quickly if you're reaching, a large sales volume and penetration into rural Zambia. So I think I promised to show you how that works. What you would do is you would go back into the control tab. You would switch onto Zambia so that you're looking at the Zambian model. All of these selections are the same, and the other big difference is you're going from 5,000 units up to 1. Right, and now you definitely do need to hit the run model button, because what this button does is it produces, it reruns the model for every country across each year that the model covers. So you do now need to rerun it. I won't make you watch me press run, and it does take a while. So I'm hoping that I have here's one I made earlier slide. After running rerunning that macro, this is the slide on the dashboard that updates and gives you the results that I've just presented. So similarly for each of these others, you would need to change your country, update the sales volumes, the beginning and the end points, and it will run the macro, and it will give you those results. Ethiopia, just to say again, as another counterpoint, this is also looking at 5,000, 5 million, much bigger market. It does eventually start to have diseconomies of scale kick in, but compared to Zambia, you've got probably a longer road to run before you start to see negative diseconomies of scale coming into force. On to a third and final use case. So this is something we added reasonably late in the modeling process, but probably something we think is important, in that we have added, and I should say it's entirely user-based, it is entirely assumption-based, but at least we've added the mechanics of what running a carbon or other outcome-based program would look like, and how that's going to affect unit costs and revenues. So I just want to show how that works. I guess this could be a company or an investor or a carbon project developer or another outcome project developer who's reasonably new to the sector, is impact oriented, wants to make deals and doesn't have loads of time to get under the hood of the details of the clean cooking business and how the economics of that business work, but does want to understand essentially some of the key cost centers and at sort of what scale it's going to make sense to start generating outcome-based payments. What the model lets us do is decide when you want to have begin generating, let's say, carbon credits and generating carbon revenues. When you want to start putting that program in place, how much it costs you to do so, and then how much revenue you're expecting to generate per unit deployed, essentially. And based on those selections, we have a couple of graphs that show in red the unit costs, in green the unit revenues per unit, and then with the darker shadings, the sort of carbon or outcome-based module coming in as well. And I guess what I think this helps do is explore some of the timing questions around, this is again going back to our Kenya example of a business that's starting to see attractive unit economics in the first couple of years when it doesn't have a carbon program active. And then if it goes quite quickly into the carbon project route, a few years of setup costs and having to put that carbon program in place, which pushes the unit economics initially down, and it's incurring more costs than it's generating revenues to begin with. And then gradually over time, in this example, those revenues start to come in and outweigh the initial and the ongoing costs of running the program. Now that does matter. It does depend what scale you're operating at. And there is clearly a time question here of how do companies deal with the costs and that cash flow challenge of the costs coming in quite a bit earlier than the revenues that they're going to be generating. So just to show you how that selection would work, I've gone back to the first model I showed you with a Kenya distributor distributing a biomass stove. And what you want to do on this one is go down into the selections for the carbon revenues. You want to turn that on. And what you want to do is select the option to share revenue with customers. There's 4 options in here. One is that the company keeps the revenues. So any carbon revenues generated are kept by the company. The second is that they share those revenues with customers, at which point you have to define how much is being passed through as a percentage of revenues generated. The next option, which we can look at in a couple of slides, is to subsidize distribution of the stoves and then retain any subsequent revenues generated, or indeed to provide that initial subsidy to help deploy the stoves up front and also share the remainder of revenues generated with customers. So it's probably not comprehensive, right, in capturing all the ways you could use carbon or outcome revenues, but at least gives some illustrative functionality. What I would say, or should have said, is the cost of setting up the initial carbon accreditation program and of ongoing monitoring costs on a sort of fixed per year basis or per credit. This is loosely based on some of what we think we've heard from people in the industry, but it's certainly not. We're not predicting or claiming these are the right amounts to have. And so I think if you're looking at using this functionality, you do need to interrogate what you put into some of these selections, including the carbon price, the volume of carbon avoided per household per year, etc. These are all hopefully transparently defined as user inputs. They're not predicted or benchmarked in any way in our toolkit. So having made those options, again, you want to be rerunning the model. Again, I will not make you watch a macro running. Instead, I will flip over to one where I've pressed that run button, and you can see the 2 slides that I put up on here with the same cost and revenue profiles are now generated on the dashboard tab. So that's how that works. And I guess the next thing that I will show you how to do, and I can show you a bit more dynamically, is that second option of let's now consider going through to a carbon business model where the stove is being subsidized up front and they are sharing revenues with their customers. So as I just described, and this I know I don't need to run the macro to show you how it works. If I change the business model from sharing revenue customers to subsidizing and sharing, and I then flip back over to the dashboard, then that's how I'm producing these results different across the two slides. So you should run the macro when you change selections to make sure you're looking at the right results. For some of them, I know you don't need to, and I chose those as examples to show you how it works sort of in real time. Fantastic. That's the end of looking at Excel files, I promise. I believe the model toolkit is either already available or will be made available. So obviously encourage people to download it, play with it, see if it does things that you think are interesting, and let us know. But just before I pass back to Lindsay for some sort of closing comments and next sort of what we're doing next, and also to see if there's been questions in the Q&A, I do just want to talk briefly through some of the caveats and limitations, and indeed some of the things the model doesn't do yet, but are not far off and might be logical extensions. So it really is, and I hope that came out of the presentation, it absolutely is an input-based analytical model. Excuse me, if you're using this, the more you can customize, look at the assumptions that are made on that control tab, and start putting in your own data and your own assumptions, the better. If you don't, essentially it works, the mechanics are all there, and it will give you what we hope are illustrative benchmarks, but obviously the more you can tailor it, the better it's going to fit your needs. The second thing it's a first attempt, and I think Faisal spoke to this much better than I am. It's a first attempt at modelling what are quite a complex series of relationships. So there's undoubtedly elements of this that are crude approximations of the complexity of the real world. That's a caveat that all economists or modelers could make, but I think it is particularly true given the complexity of the clean cooking universe and the technologies and business models. That can only really be improved if we're able to start generating more data and accumulated sort of industry-wide data points and benchmarks. I think I've said it plenty already, but it's certainly not predictive tool. So we in no way think this is a replacement for company-specific financial models. It doesn't do due diligence for you. It doesn't use any company data directly, so it certainly can't predict or pretend to predict representation of a particular business type. What we think it can be used as is a resource with a little bit of skepticism and caution applied. But I think we hope at least it's useful in a process of considering how the unit costs and revenues are likely to evolve for different businesses in different contexts. And it's a starting point, not the end point of understanding how unit economics of clean cooking markets work. It also isn't a market model, so it doesn't at the moment solve properly for a sort of interactive supply and demand dynamic. It also doesn't have a sophisticated financing module, so it's not predicting how companies should be financed, nor how they should provide a rate of return to their shareholders and lenders. So those are the sorts of things that are extremely practical and are not explicitly captured in this model. Which probably leads to some of what we think are fairly intuitive potential extensions. There's a lot in there that speaks to supply and demand. You can look at them separately. Putting them together would probably be doable, and having a sort of almost a market solving model would be quite a bit more work than we had scope for here, but it probably could be done within the same sort of framework. It would be great to dig deeper under some of the relationships between cost drivers and scale. So I talked to a couple, population density and rural infrastructure access. Even those, we've had to make assumptions on what the appropriate cost multipliers are, moving into higher and higher or lower and lower other population densities. But there's also a lot of other cost drivers that are included in the model, but not sophisticated in terms of how the relationship between those cost drivers and scale are modeled. And so improving the understanding of what cost drivers affect unit costs as scale changes would be a great thing to add to this model. As you saw, we've got a module on carbon revenue generation. We don't have the same equivalent built for any other outcomes. you could probably use those mechanics in the same way for other outcomes, but it might also be good to sort of consider those separately and work out the differences between other types of outcome markets and carbon markets. And I think one of the things that we definitely haven't done and might be interesting is looking at where there is positive unit economics for some customer segments and negative unit economics for others, working out how to set up sort of cross-subsidization as you increase market penetration, much in the way that integrated utilities do in Europe or in the US, but working out how to put in place structures where, be it carbon revenues or just sort of sales revenues, might be able to be ring fenced and recycled into serving lower ability to pay customers. And then the last few I'll do really quickly. More data. We didn't have lots. The more data, the better, either to update assumptions in the model or indeed to build in integrated input data in a way that we haven't been able to so far. I do think adding a financing or a financial model of sorts could be interesting to start looking at how business models evolve and what happens if you're looking at different types of grant, equity, and debt mixes in the business. And I think we'd obviously love to hear your feedback on the user interface and how it works, what it lets you do, what it doesn't let you do, and increase some of the depth of the outputs that are generated in the model. At which point, I think I've got through that quick, perhaps too quick overview of what the model does. And Lindsay, I will pass to you in case you had a few closing remarks or indeed want to move us into the Q&A.
Thanks so much, Ed, and appreciate those that have already been putting questions into the Q&A section. So we'll get to that in just a second. I wanted to quickly share my screen just to kind of talk about the next steps from CCA's side. And just to quickly kind of say, I think from a CCA perspective, as I kind of mentioned in the beginning, this is really a leaping off point in how we're thinking about this journey and just a starting point, but maybe not even necessarily as, it's kind of been mentioned by Ed, we were hoping to have sort of a data reflective tool or at least a data reflective report, and that hasn't been the start of the journey. So I think just to kind of emphasize where we are going from here, one is just to say that you can access the tool from the CCA website, and we will be sharing across a link to the tool, the associated report, and a recording of the session on our website. So we'll share that out along with the thank you email for attending this webinar, for registering for it. The second is to say that we would really be grateful if you do start to use the tool to receive your feedback. So if you could share across any feedback, you can use my email address here, and we'll also share that out, but that is also available on the website and will appear, just to say you can reach out to myself to discuss kind of feedback and use of the tool. And then the last is just to say that we are explicitly looking for partnerships where that can be a sort of richer, deeper relationship for those than just simply using the tool and slightly refining it. So if you are interested in a more structured partnership opportunity, we would be grateful to hear from you on that as well, where we maybe can work together on a portfolio of companies to leverage the tool and some of the insights. But again, trying to sort of start working towards that further journey of being able to create a more data-rich sort of understanding of the landscape and path to profitability for clean cooking companies. So happy to talk about that with anybody on the call as well. I think with that, I think Ed, you were saying that Iwona might join us for the Q&A session, so I can stop sharing my screen and we can start addressing questions. But thank you.
I can also see the Q&A now that I'm not sharing my screen, so Iwona, you're welcome to read them out, or I can answer them directly. Might make more sense. Yeah. Yeah, thanks all for the questions, and they all make sense, which is, I guess, on one hand reassuring, but also does mean that they're good questions. So I'll just run through the four that I can see that are open, starting with Dan's question on if and how we've modelled returns to scale and the upstream costs are staying the same at 3 million compared to 50,000 units is a very, very good question, and indeed one of the key findings in the report, which I believe is either public or soon to be made public, is indeed that upstream is one of the areas where you've got the highest potential for generating economies of scale. I will check exactly why that is. I think it's by virtue of one of the selections made of essentially that business model was looking at sort of external importation of those units at a fixed unit cost, but definitely acknowledging and agreeing with the point that upstream costs do have probably the highest potential for bringing down unit costs as they scale up. So two-part answer. One is we'll check exactly why that's not changing in the examples that we gave, but agreed that it should. There are things that don't work perfectly in the model as well, and I should also acknowledge that I'm not sure we've got all of the returns to scale quite right. To Evelyn's question, caveats and limitations are quite weighty. Is there anything that can be done to make the tool more usable? I guess there's two-part question to that question. I think the caveats and limitations are quite weighty, but I think they need to be in that what we don't want is for people to take away this tool and use it in a way that it is not appropriate, and to I wouldn't want someone taking this away and thinking this predicts how I should structure my business or my entry into Mozambique. I think it might be part of a process and it might help inform that, but we did want to be clear that it does have limitations based on the data that's in it. I think that's probably different to the second part of the question, which is, can it be made more usable? My request would be, we'd love to hear from you, I guess, and yeah, it'd be fantastic to hear if people do start trying to use it and indeed find that some of the control tab is just too unwieldy. There's too much going on, and then we can start to reflect on that. Shall I answer the other questions and then pass to you, Lindsay, or do you want to come in?
Well, I just wanted to comment on that one explicitly and just say, I think that we did go through quite a bit of revision to get this into a more simplistic state. And I think our sort of answer is that it's also just a complicated aspect of the business, an important one to help people to start thinking about as well. So I think, as Ed said, the feedback will be absolutely useful as you're starting to use it, but I do think it's not to be underestimated as sort of an important kind of process for a company to go through as well to start being able to answer some of these questions.
Yeah, fantastic. On Laura's two questions, the first one, give some examples of how and why different stakeholders might use the tool. Hopefully I gave a couple, but agreed it wasn't a particularly comprehensive overview. I think one of the things we didn't talk about, for example, is there's some functionality in there around market capture and the share of market, which if you're a private sector operator is probably important in that I would imagine nobody thinks they're going to serve 100% of the addressable market. There might be some competitors out there. There might be reasons you don't reach everybody. And so there's ways that you can use the toolkit that make it more appropriate for a private sector operator or a single company. Whereas if you're a development actor and you're looking at expansion into a new market and putting in place a program for that market, you probably do want to be looking at, well, what would it take to reach scale and to reach 100% or 80% of the addressable market? So there are ways you could use it for different purposes. I think what it doesn't have is different modules for different stakeholder types. So it isn't, if you're using it as an investor, you're using it to try and understand what the market looks like, not to try and benchmark rates of return, for example. It doesn't produce different results for different user types, if you like. And there's a question from Laura on how can we get additional support in using the tool if needed, that I might push towards you, Lindsay.
Yep, I was gonna say on the additional user support, just reach out to us and we'll be collecting feedback and also have the opportunity to offer additional deeper training on the tool as well. So that is absolutely something you can use my email address for, and I'll happily respond and would look forward to that opportunity.
Which might be the same answer to the next question from Caroline as well. Which I guess my initial thought would be, yeah, if you've got portfolio companies who use the toolkit and look at it and start seeing what it can produce, knowing how they use it, how they interact with it, and indeed what they find most or least useful. Again, that sort of feedback would be really helpful. I don't know if Lindsay, you agree or want to add to that?
Yes, and I think, Carlin, just in the case of having had a conversation with you, before this webinar as well, and just to say to others, I think really what we're looking for in terms of information or aggregation from the companies that we hope to anonymize is more along the lines of the survey that we had originally sent out. So I'm happy to share across the survey that we had originally used, which is sort of the streamlined version of this. And this is like the sort of top line information that would be useful to track for the sector to be able to kind of create some of the insights that are shown on the dashboard in a more rich and meaningful way. So happy to share that across as well. But that I think kind of boils it down to the exact data or information we'd be looking for. I don't see any other questions coming up in the chat, which I think presumably means that people want to go play around with the tool and then come back maybe with additional questions or insights. So I think I was saying, unless Faisal, you had any other closing words or anything else you wanted to say, I think we could stop there.